Let's welcome our market master for the day, Abhay Laijawala, Managing Director, Head of Research at Deutsche Equities. He's joining us from the sidelines of the DB Access India conference, from where we have been getting you a host of guests over the past 24 hours. Morning, Abhay. Thank you very much for joining us and finding some time from your investor conference. What's the mood at the conference itself? Now that the budget is behind us, how are people looking at earnings and multiples and index levels?
So the mood is interestingly cautiously optimistic. Clearly, investors have been very positive, were very positive. But with the earnings acceleration being slower than anticipated, they're clearly looking out for how all this optimism is going to ultimately translate into both earnings growth and, of course, the broader economic recovery. So it's a wait and watch right now. In fact, I think what we are now seeing investors do is they're saying budget's over. All eyes now on the budget session. So with about 4 ordinances awaiting parliamentary approval, they're watching out for execution on that front, and how the government is able to move on some of these ordinances, ultimately converting them into law. So they're watching that particular progress.
Abhay, hi, good morning, and good to see you in. The takeaways from the conference so far, at least what we covered yesterday, was quite positive and optimistic as far as foreign investors are concerned. But tell us what your own assessment is about the valuations of this market, because even if you take a Sensex EPS of say about 1400, 1430 for the next year, this market is trading at 20 times FY16. Do you think the market looks expensive, as the macro position is yet to translate in terms of earnings?
So here we've got to, look at 2 things. We've got to look at absolute valuations, and we've got to look at the world, India relative to the world. So in terms of earnings, our analysts are expecting earnings growth of 16% next year. That puts the markets at about 17 times 1 year forward earnings. So in that sense, according to our numbers, it's not necessarily looking that expensive, because this implies a premium of just about 9% to the past 5-year average. Other than that, we've also got to be cognizant of the fact that we live in a relative world. At this point in time, in a deflation-oriented environment, we are looking, India is looking extremely attractive. 51% of our, imports constitute oil, gold, silver, fertilizers, and prices of many of these commodities have come down to a multi-year low. So that's ultimately got to translate into the broader economy. And of course, within the emerging market space, India stands out on account of its very credible inflation targeting, which has, given the currency very considerable stability. So we, rather than look at India from an India absolute basis, we've got to see it from a relative basis, together with the currency stability and, of course, the other overall global commodity trends.
Okay. Well, given the budget and the rate of the stage of economic growth, which are the horses you're betting on?
So, we are very positive on industrials and infrastructure stocks. And let me give you one statistic. We were going through the finance minister's speech. Me and my team were going through the finance minister's speech very carefully. And we analyzed that the word investment was used about 60 times in this speech, relative to about 31 times in the July speech. And the word ease of doing business was used 10 times, or rather the phrase was used 10 times relative to once in the July speech. So that clearly underscores where this government is coming from. They are focusing on investment-led growth, and look at some of the very innovative decisions that they've made. Look at this proposal, for example, to launch the National Infrastructure and Investment Fund, where the government will seed that fund with an equity of 20,000 crores. And that can be leveraged many times over at both the central as well as the state level. I think that was a very innovative measure, and that actually helps the government fund investment without being confined by the fiscal deficit, because that will allow the government to use leverage many times over. So there were many small things. For example, the government's decision to give out government projects on a plug-and-play basis, outstanding. That reduces risks considerably. So therefore, our preferences remain industrials, infrastructure, and as a corollary, banking.
But okay, just industrials and infra, you're going to find very few stocks with even decent balance sheets, forget healthy. So how do you sift?
No, so you look at the entire ecosystem. You move beyond just infrastructure. You move to building materials, for example. So I guess we are probably going to see that entire ecosystem of stocks do very well, and that will ultimately include logistics, that will, transportation. So it's that entire space.
In fact, I wanted to come to that, Abhay.
And we'll have to be prepared for valuations to, we'll have to be very prepared for valuations to become very rich in many of those sectors. So that's something that investors, not that valuations are not rich already, they are rich, but I think the prospects for valuations to become richer is more likely than not moving forward.
So cement is one such sector, right, where it is could be a big beneficiary of this Make in India theme, of this home theme, but the valuations are looking very stretched. Will you still increase your weightage in the cement space?
So we are overweight in that sector. So and we have been overweight and we remain overweight.
And you'll play financials only through private sector banks, or will there be a smattering of public sector or NBFCs?
It will be a combination once again of private as well as select public sector, and of course NBFCs as well. But within the NBFCs, we would prefer to look at the more urban-focused, or let me say the relatively less, more of the urban-focused names.
Okay. Just wanted your thoughts on, how to play a couple of these other spaces like IT and pharma. I mean, before the budget, there was a bit of caution, right? And people were increasing their position in IT and in pharma names. But now that it's clear from the budget that the big play will be on cyclicals, do you shift out of your, or rather reduce weightage in your IT and pharma positions?
So, beginning of the year itself, this was our strategy that 2015 is going to be a year of public investment-driven macroeconomic rigor. So in the model portfolio for the year, we had gone underweight on IT services because the focus was very clear on the domestic cyclicals. So that stance continues.
And one final question then on the conference takeaways itself. I mean, we've been getting a lot of feelers from yesterday, but what has your own assessment been of whether people are ready to put in more money into India in the next leg of this move?
So very interestingly, we've got a good mix of clients comprising emerging market clients as well as, clients focused on more towards the global funds, not the EM space, but global. So the clients focused on the emerging side, emerging markets, they are very overweight, but we are seeing a lot of interest from the clients who are focused on MSCI world. India is extremely underweight in their portfolios, and they are now warming up to India. And therefore, we have a lot of those investors, who are asking questions, who want to learn more about India.
Okay.
So my sense is that the incremental share of flows will come from those clients than the emerging market clients.
All right, Abhay, we'll leave you to your conference yet again. Thank you very much for joining us with all your takeaways and your analysis of where you see the markets.